Um, I'm Frank McLaughlin. I'm today's presenter. I've been working with Gray Gray for about 10 years now in our McDonald's practice franchise group here. Most of that time has been working with owner-operators just like yourself. I appreciate you taking the time to participate in today's presentation. And before we kick off, I would like to share some brief background information about Gray Gray. We have a long relationship with McDonald's franchisees, working with them for over 50 years, and have developed a very specialized and dedicated McDonald's practice group. We provide all the services you would expect from a CPA firm, including accounting and tax work, but we go beyond that. We go with financial analysis, reporting, business planning, and personal financial planning. One technical point before we begin: if you have a question during the presentation, please feel free to type your question into the questions box on your screen. I will get to the question either right away or a little later in the presentation, whatever is more appropriate. So let's get into today's webinar. So what we're going to cover, right, about MRPs, rebuilds, and reloads. So before I get into that, I wanted to just talk to you briefly about what my thought process was when I was putting this presentation together. I wanted to kind of go through what I would go through with a client. I wanted to go through that same process about how we came to a decision on whether or not an MRP or rebuild or reload makes sense. If I had one goal for today, I would tell you that it was this. If I could change, everyone has a thought process and the way they make decisions. If I can add to that in a little way to benefit your organization, then I've hit my mark. So with that being said, what are we going to cover today? You know, what's that process that I'm talking about? The process I'm talking about is the current landscape. What is your current situation? Second would be future headwinds. What are those future headwinds coming against your organization without any MRPs or rebuilds? Understanding your vision plan. You may not know this, you may know this, but McDonald's has a vision plan for your restaurants. Then it's what's your organizational plan. And then it's, once you've come up with your organizational plan, revisiting that plan and adjusting it accordingly as the time passes. So just like I talked about, the first step of the process for what we go through with our owner-operators is such. What is your situation today? I don't want to talk to you here about what impacts your ratios. I want to talk to you about, do you know your ratios? Do you know what your cash flow coverage ratio is? Do you know what working capital is? Do you know what net debt equity is? Right? If it's, you know, do you have a 1.5 cash flow coverage ratio, or do you have a 0.9 cash flow coverage ratio? A step further, and what I think is really important, is knowing that sensitivity. For example, if you have a 0.5, and we all know that the minimum for cash flow coverage ratio is 1.2, what's that 0.3 gap? What does that mean to your organization? So is it $50,000? Is it $100,000? Is it $200,000? What is that gap? What's that sensitivity? Same with working capital. You know, you don't get to see working capital. You see liability turnover in days, which is a 14 or a 7 or a negative 14. But what does that equate to in dollars for your business? Net debt equity. You're either in that 25 to 69.9% range or over 70. Well, how close are you to those barometers? Are you close to 25%? Are you really close to 70% to get that extra point? What is the dollars you need to do in your business to get you to that 70? Knowing your sensitivity. Determine your strengths, right? Let's just say your working capital is very small or negative, right? But your cash flow coverage is strong. Your cash flow coverage is your strength, right? Or other, you know, maybe your cash flow coverage is 1.1, but you have $750,000 in working capital. You know, that's your business's strength. Know your business's strengths. Here's the ratio sheet that I hope all of you have seen and you get, and you know it. You know this is what tells you what your ratios are and how your business is doing today. You know, if there's one thing, and when I go through this presentation, I want to tell a story to you. I'm trying to tell a story so that you understand kind of the thought process that we're going through. So I'm going to kind of follow this owner-operator A, through this whole thing from current situation, what their headwinds are, you know, what McDonald's plan is, and how it's going to impact this owner-operator situation. and how we're going to change that to make this owner-operator make that decision work for them. So, this sheet, as you know before, tells you everything you need to know about your current situation. For this owner-operator, they have a 1.67 cash flow coverage ratio and a negative 14.1. But like I said before, what is the sensitivities? What is that 1.67? How much dollars to this owner-operator or to you does that equate to? And I'm going to show you kind of how we do it in a real quick way to find out what that sensitivity is. Let's look down here, right? I have this little sensitivity box. So you can see that this owner-operator, and this is a 5-star owner-operator, by the way, has a 1.35 million cash flow, $1,000 in G&A, $350,000 in draw. For cash flow after G&A and draw, $750. Debt service is $450 for 1.67. But what does that equate to in dollars, right? Well, this is how I did it. I took the $450, I multiplied that by 1.2 to get to this $540,000. That's the amount that you need to cover to get that 1.2 cash flow coverage ratio. So then I took what that current situation is, that's 750, subtracted 540 from 750 to get 210. So that 210 for me is that owner-operator sensitivity. That to them is their, and I'm going to put this in air quotes, but that is their cushion, right? That is if, and this never happens, and I hope it never happens, but on this 5-star operator, if they had road construction on all their stores and it impacted them $40,000 a store, they'd still be over 1.2 because that's going to be a $200,000 impact. You have that cushion, right? But also let's talk about how else you can use that cushion, right? Let's say you sat down with your personal financial planner and you said, and they said, you need to stock away $120,000 a year so that in the future you're going to have enough money to live the lifestyle you want to live. Well, we can see right here that 120 off of 210, you're still good. You still have a cushion. Know that cushion. To go a little further, liability turnover, right? Negative 14. What does that mean? What does that mean? What does that mean to dollars for your business, right? That sensitivity, and I'm going to show you in a little bit. So when you pull up your ratios in WebFFS, and I forgot to do this, so I apologize. I'm going to plug WebFFS right now, a really powerful tool. Being able to pull these up in Excel, doing these sensitivity analysis really quickly and knowing exactly where you are, powerful tool WebFFS is. If you're not on it, I would really recommend you do. So where did I get that 475? Well, let me tell you, when you pull up your ratios, there's going to be two little tabs at the bottom. There's going to be a ratio tab and there's going to be a balance sheet tab. And I'm going to show you on the next slide what that's going to look like and where I got that number. So let's get over to it. Right, so this is that balance sheet tab that I'm talking about. And this is just a little snippet. This is like the bottom right-hand corner of it. But what I really want you to kind of look at and where we're coming up with that working capital number is right here. Right? Now, you're going to see that this is only for 6 months. But what I want you to really know is that 475 is right here, right? And it's telling you what your current assets are over your current liabilities. That's the money you have or your cushion in case something were to occur. You can use that money to put down $200,000 in an MRP if you want to, or a rebuild, right? The other thing I want you to look at when you look at this is trends. You can see here that this owner-operator went from 325 in April to $150,000 increase. They're increasing. Their working capital has been increasing over the last 6 months. Know your trends. Are you decreasing? Are you staying flat? Kind of what's causing that? What are the things that are causing you to stay flat, and how can you maybe make it increase? So on to the next. So now that we've talked about your sensitivity, knowing what those cushions are for your business, really important stuff. The one other thing I just want to talk to you about is your trailing 12-month activity. Remember, McDonald's looks at your business over the last 12 months. That's what they look at your business about, right? They're doing all your pre-debt cash flow, your draw, your G&A, everything over the last 12 months. So knowing there's a big amount that, let's just say what I'm talking about here is, you had a review last year and you wanted to put $150,000 in your business to improve your ratios. Well, guess what? In 12 months, that's negatively going to impact you because it falls off. Let's talk about tax draw. You know, you had a $400,000 bill in April. You knew about it because you talked to your accountant, and of course, he's the best, right? And what happened there is that $400,000, yeah, it's going to negatively impact you now, but in 12 months, and the next April comes up, it's only $100,000, right? That's going to positively impact your situation by $300,000 after that 12 months is up. You know, and I know this never happens, but let's just say McDonald's decides to give you $100,000. And because there's no line item in your P&L saying generosity of McDonald's, you're going to put that into miscellaneous income. Well, that miscellaneous income is only on there for 12 months. And if we take our $1.3 million owner-operator and pre-debt cash flow, you know, and that 12 months goes through, that drops that owner-operator down to 1.25. So that cushion isn't 210. That cushion's only at 110. So really look and see when those big variances happen on your P&Ls or your draw, so that you know really kind of what you annualize your trailing 12, so you know exactly what your business is doing and what you can do. So we talked about our current situation. We know exactly what the situation for your business is today. We know all your sensitivities, right? For this owner-operator, $210,000 in cash flow, $475,000 in working capital. We know that. But what are our future headwinds? What are those things that are coming up and are going to impact our business regardless of our MRP and our rebuild, right? Because we don't want to get into one of those. We don't want to get into a project without knowing exactly how our business is going to react, right? We're talking about minimum wage increases, health care, increased taxes, increased commodity prices, sluggish sales. You know, I was in a ROA, and a finance director got up and he's talking, and he said that for every 10 cents that minimum wage increases, it can impact your cash flow by $6,000. That's a pretty big number. Now, every one of you has a different headwind, right? If you're a two-store owner operator, healthcare may not be a headwind. Maybe you're not in a state where minimum wage is increasing as much as others, right? Maybe your sales are trending better than the company, so really, you need to look at this for your business and say, what are my headwinds? What are the things that are going to come up? You're going to see when we go through the example that I picked $50,000 a store for 5 stores. It's a $250,000 impact to your cash flow. Now, I'm not saying that's what it's going to be for you. I'm just saying I'm using it for this story and for this process. Right, so we talked about the current, we talked about the future. Now we need to understand the region's vision plan. You may or may not know, but your region gets together around the table once a year and goes through each of your restaurants in the region and says, I want to MRP this one, I want to rebuild this one, I want to reload that one, and this is when I want to do it. And they're doing that separate of the owner-operator. So they are not looking at that, and they're not looking at your organization. Right? They're looking at just that store, that restaurant, the age of that restaurant, right, and what they want to do with it. So you need to know your company, you need to know what the regional's vision plan for your stores are, if they want to MRP, they want to rebuild, and what years they want to rebuild it. Real quick, know your rewrite and lease end dates. And the reason I say this is we know that McDonald's looks 3 years before your rewrite date and can tell you, and we all know that yes is a maybe and no is a no. Right? And I don't ever want to put myself or my clients in a place where they could put themselves in potentially bad situations. So let's just say in 2018 you have a rewrite date. The company wants you to do a rebuild in 2016 and it's going to negatively impact your numbers and your viability. Not something we want to do. Maybe we need to push it off a year, or maybe we need to put some more money down, right? Just know these dates because these are important for your overall planning strategy as an owner-operator. So I say we work inside the framework of McDonald's. I know that some owner-operators, and I've sat around, well, they want me to rebuild this store, but I know if I rebuild that store, I'm going to get a return on my money. I'm going to really kill it on that store. That may or may not happen, yes, but for this scenario and this story, and we're going to talk about, we're just going to work inside the framework of what McDonald's wants us to do, right? So we're going to build that plan. We're going to build McDonald's plan and see if it works for your organization. Now, because of the fact that McDonald's doesn't look at your organization, they just look at your store and that it's a 40-year-old store, you know, most likely than not, it's not going to work. It's not going to work for your organization. Just the timing or some other factors may not work, right? So what do we need to do from there? What do we need to do from there, right? We need to devise our own plan. Now, if we're sitting around a table and McDonald's is sitting there and they think it works and you're sitting there and you like it and you think it works, and then I'm sitting there and I'm saying, you know what, your viability is good, you have no worries, that 2018 rewrite, no big deal, then we're done. We don't have to do anything. But we have to look at their plan and work in that framework and go from there. And if it doesn't work, we have to devise our own plan. So now that we've gone through all those, let's talk about our example, right? We have that 5-store owner-operator, cash flow of $1.35 million. We have those headwinds, $250,000 in headwinds, $50,000 per store. Now remember, I'm just using that number as a storyteller. You know, McDonald's wants us to do an MRP in 2015. And they want to do a rebuild in 2016. Now, for the MRP, I used $600,000, and I'm going to finance that over 7 years. I used a 5% increase in sales for that MRP, and now that may be a little bit more, a little bit less, but they put a side-by-side in, and that's what we thought was a conservative amount. They're going to do that rebuild in 2016. We did 8% increases on that store at $1.875 million. $1 million over the 7 years. And for the leasehold and building, we did $875,000 over 10 years. I'm not really talking about relos today, but remember that relos, you have the option. You have the option to buy down rent or not, and that's something that you really need to sit down with your CPA or advisor and say, you know, what makes sense for me and my organization. We're not talking about that today, but that's just a little difference in relos that I think is really important for you to sit down and say what works for me and my organization. So let's get on to there. So before I kind of get into this slide, I want to talk about, I did a lot of, this is a web FFS slide. This is the 5-year planning tool. Let me just plug it one more time. Really powerful stuff. It really gives you a lot of insight into how your business is going to do and what it can do for you. So I really, if you haven't gotten to the 5-year planning tool, you know, sit down with your CPA and work in it. If you haven't even, you don't really want to call your CPA, you just want to play around in it. Just some of the things that you can do and see the differences and how they affect your business, really powerful stuff. So this is, remember, when you're going through the 5-year planning tool, you go through all these sheets and everything, and then this is the outcome. I've gone through all the background noise just to show you the outcome so that we can talk about it. This is one of the sheets that it produces. I'm going to show you 2 of the, I think it's 5 or 6 sheets, because I think they tell us the best part of the story. So let's see what this is telling us right now. Right? I want to show you because it tells you 2 things. It tells you your organizational measures before investment and reinvestment. Now this is a really powerful thing, because this is that, remember we talked about what's your current situation and what are the future headwinds? This section is telling you exactly that. This is telling you exactly how your organization is going to be regardless of that MRP and rebuild. Let's see what it tells us, right? That pre-debt cash flow number, 1.162. Remember it was 1.35? Look at the cash flow we've lost because of those headwinds, right? Look at this. Cash flow coverage ratio, 1.22. We're right on that threshold, right? We're right there at that minimum. And we haven't even done anything yet. So now I'm starting to sit back and say, "Ooh, that's a little scary. Maybe we need to think this through." And this is why I love the 5-year planning tool right here. Cash flow dollars above or below the minimum cash flow coverage 1.2. You know that cushion we were talking about? $7,000. That's all you have. Now if you get that road closure, it's going to drop you below 1.2. Right? So this before investment and reinvestment screen kind of tells you how your operation is going to do, and it really, I think, gives a lot of insight to how things are going to go when you do your reinvestment, right? We can already tell it's not going to be good, right? So let's come down to our after investment and reinvestment, right? We can look right away, and McDonald's does a great job on this report, and it's going to be red if you're below 1.2. Here it is, 1.08, right? We had a little bit of cash flow increases of 1.1 because we had that 5% bump, and that's the amount of money it's pulling in for your business. You know, but like I said before, that cash flow dollar is above and below the minimum. $61,000, you're below that 1.2. Now you may sit there and say to me, Frank, I know I have some, you know, my draw is a little fatter. I can get some P&L things. I can make up that $60,000. Okay, that's something that you need to sit there and talk about and say, we can do this. I can do this, right? Let's look at 2016 when we're doing that rebuild. We lost some cash flow because our store was closed for 3 months, but now look, we are below 1.0. So no matter what you do, you're going to be a 5 or less in your point total for your financial viability, right? Look at this, $147,000. Now you may be able to make $60,000 up in 61, but $147,000 could be a lot more of a challenge. So a really powerful tool to show us what we can do and what those gaps are so that we can hit our marks. Now, remember that little scenario we talked about where we have rewrite date in 2018. That 2016 is in that window for us. Now we're chancing it. We're opening up a little bit of probability that something could go wrong. Now McDonald's may not think that because they see the strength going forward, but I don't even want to chance that. I don't think you do either. So the next sheet I'm going to show you is the working capital sheet, right? So we saw the cash flow sheet and what that's doing for us, but I want to show you the working capital and that second sheet we're talking about with regards to the 5-year planning tool. So this is really kind of just to show you a really quick snippet, but the things I want you to pay attention to, right, is this. Year 2017, $756,000 in working capital. That's your current assets over your current liabilities. And 2019, $1.6 million. Now, I'm only showing you this because when we make our changes, because we know it doesn't work, McDonald's plan doesn't work, I want you to remember this so that you can see how just changing a little bit of one thing here or there can really impact not only your cash flow coverage, but your working capital as well. Right? So what are the changes we can make? What are some of those changes? Right? We just went through it. Me and you were sitting across the table. McDonald's vision plan did not work because we knew it wasn't really going to, because they're not looking at me as an operator and saying, well, I need to do that rebuild, and if that's going to work for that operator. So what are the changes we can make? We can move the date of the project to when debt falls off. We can consolidate the debt, right? I just had an owner-operator consolidate their debt, and it's saving them $6,000 to $7,000 a year. That's 72 grand. Now, remember the scenario in that first year, it was a $61,000 gap. Well, if you consolidate your debt, you're going to come back over 1.2. You could put money down. We're talking about this owner-operator, $475,000. Maybe they can put $200,000, $250,000, $300,000 down, and it makes this work. You can decrease our draw of G&A, or we can improve our P&L profitability. Now, I'm not going to touch consolidated debt. I'm not going to make you put your money down. I'm not going to decrease your draw on G&A. I'm going to move the dates of the projects. And just by doing and moving the dates of the projects, wait till you see the outcome. Right. So now this is that sheet we were just going from the WebFFS 5-year planning tool. And I want you to kind of understand where I came from and the decision I made when I said when debt falls off. Right, because this is, and look at here in that red circle, annual debt service. Look at what's falling off. In 2016, we have $125,000 falling off. 2017, $200,000 falling off for your organization, and another $118,000. Wow, these are some pretty significant decreases in your annual debt service, and maybe they're the times we can use to do those projects that we want to do. Let's see the results of, and let me just tell you what exactly I did. All I did is change the dates. I moved the MRP from January 1, 2015 to January 1, 2016, and I moved my rebuild date from March 1st, 2016 to March 1st, 2017. Let's look at the results of that. We're going to have that 1.22 in 2015 because we didn't change anything, no change. But look at 16, 1.55. Look at 17, 1.558. Look at the cushions we have, $138,000 and $144,000. Just by changing the dates of your projects to what makes sense for your organization, you've now put yourself in a better scenario moving forward. And just like I said before, and I want to show you what it looks like for your working capital, because now we know you're going to get the high marks on cash flow coverage. How are we going to get high marks on working capital? Well, look, remember those numbers in 2017, right? Was it 750 and 1.6 million? $1 million in 17, almost 1.9 in 2019. This affords you a lot of opportunity. You have $1 million in 17. Now you can, if you wanted to, use that money to buy a new store and put down a pretty good chunk of money. But just by moving the date of a project 1 year back, you've now not only improved your cash flow coverage ratio, you've improved your working capital and given yourself more options to better prepare yourself for pretty much anything you want to do. Maybe you want to rebuild another restaurant. I don't know. You know, it gives you options. Money affords you options, right? And that's what we're doing here, and that's what we're showing. Right? So with that being said, we just showed how one little thing can really positively impact your organization. Now, and I'm not talking for the company, and I don't want to say they're going to say yes or no, but I would find it really hard for the company when you go to your region to sit down and say, I really want to do this MRP, I really want to do this rebuild, you know, but let me just push it off a year because, and here's the results, here's why. Right? I have this debt falling off. Look at the results that I have. Look at the cushion that I'm going to have. Look at the working capital. I'm going to find it hard pressed that they're going to come back to you and say, no, right? They may, but you're at least starting from a point. Maybe they want you to just push back a project 6 months instead of a year, you know. But you're starting that dialogue and you're really talking in region to make it work for your organization, right? So we talked about your current situation. We talked about those future headwinds. We talked about McDonald's plan and how it does not work. We talked about your plan and how it does work. Now we have McDonald's. They signed off on the deal. They said, you know what, owner operator, right? This works. We are totally on board. We sign off. You're not done, right? Because there's so many more factors as the years go on. You know, we put in a factor of $50,000 a store for Headwinds. Was it 70? Was it 20? Do we need to adjust our projections based on the amounts that we might have been off on, right? Additional McDonald's reinvestment, right? I don't want to say it, but HD rails, you know, maybe they have something like that coming up that you need to now put into your stores that may hold back, you know, your rebuild situation. The reinvestment project's not performing as originally forecasted. Remember, I said MRP was going to do 5% and the rebuild was going to do 8%. What if they're flat? That's going to impact you going forward. What if the rest of your sales are flat or down, right? Moving and staying in constant and frequent communication with your regional office to say, look, maybe things are all down, and I hope not, right? But what if things keep going the way they are, and you're sitting there saying, I would really want to do that rebuild, but give me a little bit more time to build up some cash in my organization so that I can put the money down so that I can do that rebuild and it makes financial sense to my business. You know, being in constant communication so that if these things do happen, the regional office can say, yep, you know, we're right on board with you. Let's do that, right? And again, you know, getting the ideas from your CPA or your financial advisor. You know, you're running your stores every day. It's our job to find out what's coming down the pipe. So maybe there's some additional future headwinds that we didn't factor in that are going to pop up. So just keep on an annual basis, or maybe more than that, keep readjusting and saying we're right on mark. We're off. This is what we're off. Maybe we need to adjust. So Gray & Gray has done a bunch of webinars, and this is kind of our financial plan to win. You want to maximize your financial viability, kind of what we talked about. Continuous and future tax planning. That tax planning is really key to knowing when those, you know, when I talked about those trailing 12 months and the spikes that and the variance that occur, right? So knowing what's coming down the line, if you have a big tax bill and how that's going to negatively, right, impact your business, or when it falls off, how it's going to positively impact it. Continuous tax planning. Business planning, just like I talked about here. We just talked about MRPs and rebuilds and reloads, but purchase a store. Maybe you want to go through that same process to come up with, does a store purchase make sense for me? And then personal financial planning, huge topic right now, right? Turning your golden arches into your golden years. You know, sitting down and saying, what do I need to live and have a comfortable retirement that I want to have? Sitting down and knowing those numbers, because we can use those cushions that we talked about to really support that and really grow your investment portfolio outside of the business. Upcoming webinars, we have a top 10 year-end tax planning considerations. Well, it's to be announced, right? Because the November elections just happened. The government hasn't come up with, and they haven't made a decision on what they're going to do. So when they make that decision, we're going to let you know about it. So that's really it for my presentation today, but I wanted to see if there's any questions out there, right? Any questions? Oh, I do see one, right? I do see one. Frank, I have 70% equity, and I want to 100% finance my rebuild. Why won't McDonald's allow me to do so? That's a great question, and I don't know your situation, and I don't want to speculate at all, but I can just give you one scenario where that they may not let you, right? Let's just say you have great equity, but your cash flow coverage ratio is at 1.1, and we do all the projections, and that rebuild is going to bring your cash flow coverage ratio down. McDonald's is never going to let you do a project that's going to negatively impact your financial viability, right? So maybe they're going to ask you to put some money down or come up with a different strategy, let you push it off, and whatnot. So that's just one little scenario that they may, you know, talk to you about, and that's maybe why they're not letting you 100% finance. But really sitting down with your advisor and your CPA to understand why would be the more advantageous solution. That's it for today. I don't see any other questions. No, nope, no more other questions. So I really appreciate your time. It was about 34 minutes. I hope I didn't take too much of your time. I wanted to make this fast and relevant. I hope that there's that one thing. If I could just, you know, I hit my goal today, and I gave you that one thing that you can walk away with. If you have any questions or comments, please feel free to reach out to me. I'm open for any insight. Have a great day, and thank you very much.